Imagine this. You're shopping for a home, and suddenly mortgage rates drop to 4%. Your car loan payments shrink, and small businesses can borrow again. Sounds like a dream, right? In 2025, a surprise interest rate crash is shaking things up. The Federal Reserve slashed rates from 4.75% to 2.5% to boost a sluggish economy. But what does this mean for you? Cheaper loans, yes, but also weaker savings and new risks. From first-time homebuyers to retirees, this rate crash is reshaping lives. So what's driving it? Who's winning? Who's struggling? And how can you make the most of it? Join me as we dive into the stories, the facts, and the strategies to navigate this new reality. Let's break it down. Interest rates are the cost of borrowing money, set by the Federal Reserve. In 2025, the Fed cut its benchmark rate from 4.75% to 2.5%, a dramatic crash to stimulate a slowing economy. Why? Inflation's down to 1.8%, but growth is stalling, with unemployment creeping to 4.5%. Lower rates make borrowing cheaper, encouraging spending and investment. Mortgage rates dropped from 7.2% to 4%. Car loans fell to 3.5%, and credit card APRs eased 18%. But there's a flip side. Savings accounts now earn just 2% below inflation. This crash is a response to global slowdowns. China's economy is faltering, and European growth is flat. The Fed's betting on a boost, but not everyone's celebrating. Let's see who's feeling this shift. Meet Aisha, a 30-year-old teacher in Atlanta. For years, she couldn't afford a home. 7.2% mortgage rates made a $300,000 house cost $2,200 a month. But with rates crashing to 4%, that payment's now $1,400, a game changer. Aisha says, "I'm finally pre-approved for my dream home." She's not alone. Home sales jumped 15% in 2025 for the National Association of Realtors as lower rates unlock home ownership. But it's not all rosy. Home prices are creeping up as demand surges. Aisha's racing to buy before prices outpace her savings. Her story shows how a rate crash can open doors, but timing is everything. Now let's meet Liam, who runs a gym in Chicago. Last year, 8% loan rate stopped him from opening a second location. $50. 000 loans meant $600 monthly payments. With rates crashing to 3.5%, that payment's down to $450. Liam says, "I'm finally expanding and hiring." Small businesses are bouncing back, with 25% more loan applications in 2025 for the Small Business Administration. But low rates could spark inflation again, raising costs for Liam's equipment and utilities. His story shows how a rate crash fuels growth, but it's a delicate balance. For retirees like Margaret in Florida, the rate crash is a mixed bag. Her savings account earned 4% when rates were high. Now it's 2%, below 1.8% inflation. Her $50,000 savings is losing value. Meanwhile, her credit card debt for medical bills carries a 18% APR, still costly despite the drop. Margaret says, "I'm dipping into savings to cover bills." Retirees are hit hard. 30% are cutting expenses due to low savings yields per AARP. Margaret's story shows how a rate crash can hurt those relying on fixed incomes. Why did the Fed slash rates in 2025? It's about the economy slowing down. Inflation's at 1.8%, below the 2% target. But GDP growth is just 1.5%, and unemployment hit 4.5%. The Fed cut rates from 4.75% to 2.5% to encourage borrowing and spending. Global factors play a role. China's economic slump and Europe's stagnation are dragging down trade. Lower rates make mortgages, car loans, and business loans cheaper, but they also shrink savings yields and could rekindle inflation. This crash is a bold move, but it's a tightrope walk. The rate crash isn't just about loans. It's changing how we live. Young couples are buying homes, businesses are hiring, and car sales are up 10%. But savers, especially retirees, are losing ground, and low rates could spark inflation, raising prices again. Student loan rates at 3% are easing burdens for grads, but 35% of Americans report financial uncertainty per the APA. The rate crash is a double-edged sword, opportunity for some and risk for others. The rate crash opens doors, but you need a plan. Here are 6 ways to thrive. 1. Lock in low-rate loans. Refinance mortgages or car loans now. Aisha saved $800 a month on her home. 2. Consolidate high-interest debt. Credit card rates are 18%. Bundle them into a 3.5% personal loan. Liam cut his debt payments by $200. 3. Invest, don't just save. With 2% savings yields, consider low-risk stocks or bonds for better returns. 4. Start or expand a business. Low rates make loans affordable. Liam's gym is proof. 5. Shop smart for big purchases. Car loans at 3.5% mean now's the time for that upgrade. 6. Plan for inflation. Stock up on essentials or lock in fixed-rate loans before prices rise. These steps can turn a rate crash into your advantage. What's next? The Fed might keep rates at 2.5 to 3% through 2026 if growth stays weak. Mortgage rates could dip to 3.8%, but inflation might climb to 2.5%, raising costs. Savers could see yields drop to 1.8%, while businesses might boom with cheap loans. Global risks, like energy spikes or trade tensions, could complicate things. For Aisha, Liam, and Margaret, adaptability is key. History shows low rates can spark growth, like in the 2010s, but also bubbles. Stay informed and proactive. Share your story below. How's the rate crash affecting you? The rate crash is a chance to dream big, buy a home, grow a business, or tackle debt. But it's not without risks. Aisha's buying her house. Liam's expanding his gym, and Margaret's finding ways to stretch her savings. You can too. Use the strategies we shared. Refinance, invest, and plan ahead. If this video helped you navigate the rate crash, hit that like button, subscribe, and share it with someone who needs it. Drop a comment. How are low rates changing your life?